You've done it. You've saved, you've planned, and you've just pressed the confirm button. £10,000 has left the comfort of your savings account and ventured out into the world of investing. There's a strange feeling in the pit of your stomach, isn't there? A mix of excitement, a little bit of fear, and a huge dose of uncertainty. What happens now? Well, the truth is, everything changes. Not in a dramatic, overnight lottery win kind of way. It's slower, deeper. That single act of committing a significant sum of money fundamentally alters your relationship with your finances, your future, and even the world around you. The first thing you'll notice is how you consume information. The financial news, which used to be background noise, suddenly has your attention. A headline about the FTSE 100 dipping isn't just a number anymore. It's a flicker on your own personal balance sheet. A news report about inflation ticking up to over 3% isn't an abstract economic concept. It's a real, tangible enemy that's actively trying to devalue the money you haven't invested. You realize that holding that £10,000 in cash, while feeling safe, was actually a guaranteed way to lose purchasing power. After 10 years of 3% inflation, its buying power would have shrunk to less than £7,500. Your investment, you now hope, is its shield. This new awareness is a double-edged sword. It's empowering, but it also opens the door to a whole host of psychological traps. These are the behavioral biases that trip up even the most seasoned investors. Suddenly, you have a stake in the game, and your own mind can become your worst enemy. There's loss aversion, the loud, panicky voice in your head that screams when your portfolio is down 5%. It feels so much worse than the quiet satisfaction of it being up 5%. It tempts you to sell at the worst possible time, to lock in a small loss before it becomes a big one, even though history tells us markets recover. Then there's its cousin, herd mentality. You're on a forum or talking to a friend, and they're all piling into a particular stock. The urge to follow, to not miss out, is immense. But are you following a sound strategy or just running with the crowd? And what about confirmation bias? You've invested in a tech fund, so you start seeking out articles that say tech is the future, while subconsciously ignoring the ones that warn of a bubble. Your brain is trying to protect you from the discomfort of being wrong, but in doing so, it's blinding you to risk. This is the first major battle. Learning to recognize these voices in your head for what they are, cognitive shortcuts, not sound financial advice. This is where you move from being a passive saver to an active, disciplined investor. You start building a framework to protect you from yourself. You write down your goals. Is this money for a house deposit in 7 years? Is it the start of a retirement pot for 30 years from now? Having a clear goal and a long-term time horizon, at least 5 years, is your anchor in a volatile sea. It allows you to ignore the daily noise and focus on the destination. The next change is practical. £10,000 is a meaningful amount of money. It's enough to demand a proper strategy. You can't just put it all on one horse. You learn the most important word in investing: diversification. You realize you can spread that £10,000 across different assets, sectors, and even countries. A slice in a global fund that tracks hundreds of companies. A bit in a fund focused on stabler, dividend-paying UK firms, maybe even some in bonds for a bit of ballast. You're not just buying a stock, you're building a portfolio designed to weather storms. And you learn about the incredible power of tax wrappers. In the UK, this is your secret weapon. You've likely put that £10,000 into a stocks and shares ISA. Why? Because it means every single penny of growth is yours to keep. No income tax on the dividends, and crucially, no capital gains tax on the profits when you eventually sell. With the current capital gains allowance at just £3,000, holding investments outside of an ISA can quickly lead to a surprise tax bill. The ISA is a government-endorsed shield for your returns. For someone with a longer-term view, maybe some of it goes into a pension, where you get tax relief on the way in, giving your investment an immediate boost. Suddenly, you're not just managing money, you're being strategic about it. You're engaging with platforms, comparing fees. You understand that a 1% platform fee versus a 0.15% fee isn't a small difference. Over decades, it's a colossal one. You start to see the financial system not as something that happens to you, but as a set of tools you can use. And thanks to things like the FCA's Consumer Duty, which was introduced a couple of years back, you can feel more confident that the firms you're dealing with are now legally required to act in your best interests to provide clear information and fair value. But the most profound change happens over time, and it's almost invisible at first. It's the magic of compounding. Let's be realistic. In the first year, your £10,000 might not do much. Based on recent FTSE 100 performance, it might grow to £10,670. You might earn around £360 in dividends on top of that. It's nice, but it's not life-changing. But you reinvest those dividends. The next year, you're not earning a return on £10,000, but on, say, £11,030. It's a tiny difference. But stick with it. The historical average annual return of a global fund has been around 7.7%. If your investment achieved that, after 20 years, your initial £10,000 wouldn't be £20,000. It wouldn't even be £30,000. It could be over £44,000. That's when you truly get it. Investing isn't about picking the next hot stock. It's not about getting rich quick. It's about letting time do the heavy lifting for you. It's about your money quietly working for you in the background, every hour of every day, while you live your life. It's a slow, boring, and utterly beautiful process. That initial £10,000 becomes the bedrock. It's the proof of concept. It gives you the confidence to add more when you can, to stick with your plan during the inevitable downturns, and to see market dips not as a crisis, but as a buying opportunity. Everything changes after you invest that first £10,000 because it's a vote of confidence in your own future. It's the moment you stop just earning a living and start building a life. You've taken a risk, yes, but you've also taken control. You've planted a tree, and while you can't see the final shape of it yet, you've given it the soil, the space, and the time it needs to grow. And that is a change that goes far beyond any number on a screen. Stay money mad. Subscribe and unlock your path to financial freedom.